Welcome to Economic Impact. We are January 22nd, 2026. Happy New Year to you all. It's the first of the year. Stéfane, happy 2026.
Happy New Year.
So thank you for being here. It might be a little longer today. We have a bit more slides, but it's so worth it because the last time we spoke, it was December 9th, 2025. And we were a couple of weeks before the end of the year and saying it could be quite an amazing year. So can you give us the last minute, December 31st?
So you're forcing me to come back on 2025.
I am.
Okay. We ended the year with roughly 20% of traded goods around the world that are now subject to tariffs and non-tariff barriers.
Never seen.
It's a big number, Nancy. We're talking about $2.6 trillion. It's 4.5 times greater than last year. So despite this, and that's real protectionism for you, but despite that, if you were an investor in the global stock market, it was a fabulous year. Mm-hmm. Imagine that. Protectionism associated with more than 20% total return on the MSCI global index. Third consecutive years of more than 20% total return.
So that's why the investors are so happy and so confident about the stock market.
It's never happened before.
And what about the performance of Canada specifically?
One would think that we had a poor year because we had bad economy. Actually, we had the worst economy in the G7, but we had the second best stock market in the G7, so more than 30%. Some people will say, yeah, but 1/3 of this return came from gold stocks. I said, yes, of course, but the rest did relatively well, and it was positive returns for financials and the energy sector. So all in all, a very good year for Canada. We were the worst student in economic growth from an economic growth standpoint, but the second best in terms of stock market performance.
Okay, and now if we look at 2026, because I'm already exhausted about everything that we read in the paper, and it's been 3 weeks only in 2026, so how is it going?
A lot of noise from the from politicians. Mm-hmm. So 32%. I mean, you can't beat that. But year to date, we're not even done for January, and the Canadian stock market already up 3.7%. So are we on track to beat last year? I can't promise you this, but all in all, I can say is, despite all the political noise, Canadian investors is not losing money. All the asset classes are up this year. Notice, the bond universe is not doing all that great, but it's positive.
It is.
But look at the stock market in Canada, delivering returns that are 3 times greater than what you see in the US. So not a bad performance under these circumstances.
And what's the sentiment of investors? Not necessarily of particular individuals, but how about investors?
Oh, U.S. investors. So U.S. investors, well, they're bullish. They're looking at this and they say, we haven't seen a proportion of bullishness as high as what we see right now in 2 years. So it's midterm election year. People are expecting that the president will deliver economic growth that will be above potential, good for earnings. So that's the type of sentiment that we're seeing in the U.S.
And throughout the world?
It's not constrained to the U.S. It's not limited to the U.S. It's global. Expectation is for global equities to deliver earnings per share growth of 15%. That's 50% greater than last year, Nancy. But look, everyone expected to be in positive territory.
Look at Europe.
0 point. That's a big improvement.
It is.
It seems like people don't think that will be a follow-through in terms of global threats, whether it's in military interventions, et cetera, et cetera. But that also says that the market is vulnerable to disappointment if you don't deliver on these earnings growth. So very, very high expectations again this year for earnings growth.
Yes. And the next slide that you have is absolutely amazing. You know, when we say that an image is worth 1,000 words. So maybe you want to show it to us because it really is showing the impact of U.S. from 2020 to 2024.
So a lot of people ask me, what is Washington attempting to do? Well, they want to revert to a map of the world that is a little bit different than the one we have right now. Let me explain. Back in 2000, the U.S. was the main trading partner for most countries around the world.
That's the blue.
That's why the map is mostly blue, right? 20 years later, China has increased the size of its manufacturing sector by more than 13 times. The map has changed quite significantly. So the U.S. is not comfortable with this, saying, well, we want a greater share of this manufacturing, hence the protectionism policies that are being deployed, but it will come with other ramifications. But at this point in time, this is the U.S. strategy. They would like to see more blue on this map.
So that means you need to bring manufacturing back to the U.S. or having the U.S. being involved in manufacturing throughout the world.
Explaining how the markets are behaving right now, because, if you want to do that, it's going to cost a pretty penny. You have to invest. You got to get government involvement. It's got to be good for earnings. And from U.S. perspective, what that means is back in 2000, they accounted for 24% of global production, manufacturing production, that is. They're down to less than 16%. China has gone from 8% to 32%. So the U.S. needs to reindustrialize, and they want to do it quickly. So they're doing it with tariffs, but there's so much you can do with just tariffs alone.
Yeah, and if you want to do that, you need electricity.
You know what? Economic activity is energy transformed. You're absolutely right. So you want to do manufacturing, you need electricity.
You want to do AI, you need electricity.
Absolutely. So you want to industrialize, whether it's traditional or non-traditional ways, you need electricity. The Chinese electricity grid is larger than the US and EU combined. So the Americans need to rebuild the electricity grid. So does the European. So what does it do, Nancy? What everybody wants to do the same thing at the same time?
Prices go up for the whatever goes into it, which is copper.
And the copper input is surging right now. So
which is good for Canada because we are producing a lot of copper.
We are a producer, and we do export some copper, so it has a positive impact on the trade balance. You're right, but it's an all-time high. So you can see the reflation trade mindset in the market, saying, "Wow, there's going to be more spending. Companies are able to raise prices. That could be good for profits." It comes with uncertainties down the road.
Yeah,
but
there
right
could
now,
be tariffs that make it
that's the mentality
not as attractive to export, but
yeah.
still. And if there's more demand for electricity, basic economy, prices will go up.
And input prices are up. So guess what? Electricity prices are rising quite significantly. U.S. up 42% in the past 5 years. It's not good for politicians. Up 17%, Canada 23% gap there. So that's why I do believe that there might be temptation for the president to want to make a deal with Canada later this year on the trade front, because as you and I have discussed previously, what's the biggest enemy of politicians? Not necessarily your adversary.
Next party. It's inflation.
It's inflation.
Yeah.
So the president is mandated to bring inflation down for the midterm election year.
So lots of uncertainties, geopolitical, prices are going up, people will go for gold.
You're right. So inflation uncertainty, because you don't know which way it's going to go, and then there's a political uncertainty, US dollar uncertainty, and gold is surging. It's a big component. It's now 20% of the market cap of the S&P TSX. It's even larger than energy stocks nowadays. So that's a big deal, and I think that the path of least resistance is to go to $5,000 and maybe higher, Nancy. So that helps support the Canadian stock market.
Of course. So with all this reinvestment, and we know that governments will need to get involved, that means that the debt's gonna increase. For sure.
That gets back to your gold comment. Why are you looking for a safe haven? Because you're not sure about the discipline of these politicians in a midterm election year, particularly in the U.S., where the president has already pledged to deploy a $400 billion stimulus for the midterm election year. So that's a big deal. And with the intervention in Venezuela, pledging to rebuild the Venezuela economy, that could cost money or get government involved to help entice the private sector to invest. So a lot of government debt out there. You can see Canada, actually, we have a little bit more deficits than in the past, but
still disciplined.
Still disciplined, relatively speaking. You're absolutely right.
Yeah. And what about interest rates?
Well, if the U.S. is running big deficits like that, it's going to have global ramifications. So long-term interest rates are rising across the globe. They're surging in Japan, higher in the U.S. And what that means from a central bank perspective, you have to be disciplined too, because notice that even though the Bank of Canada has lowered interest rates from the most recent move from 3.77 at the spring of last year to where we are right now at 2.25, if you're a mortgage holder looking at the 5-year mortgage rate, the 5-year government bond yield hasn't moved.
Changed.
So we are dependent of what happens in the U.S. Hence, we need to maintain our fiscal discipline. But it shows the limit of what monetary easing can achieve, Nancy. It's not because you bring it down even more nowadays that you'll get relief on long-term interest rates. That you depend on what happens globally, and particularly in the US.
And the next slide is also amazing because we've seen everything that has been announced and implemented for immigration in Canada.
Yeah.
And I remember 2 years ago saying, you know, there was more than 1 million people coming. It was like Newfoundland joining Canada.
Yeah.
Can we see the next slide? Because this is quite a shock.
So I'm not going to get major relief from the Bank of Canada on rates because they need to protect long-term rates. But the other thing is, I'm not going to get relief from surging population to prop up growth because population growth is expected to be negative this year. And Nancy, that doesn't happen very often.
1970.
And even if I were go back to the 1950s, it's never happened. So that means lower growth for Canada.
So what are we going to do to grow?
We need to offset this. So the government has tabled a budget in Ottawa saying, well, here I need to bring back investment to the country so we can offset this by better policies meant to entice foreign direct investment to come to Canada. That's the key. We need to rebuild our productivity, and that's not going to be done without business investment. So that is the main issue for 2026, the execution after tabling a budget and the MOU with Alberta. Now it's all about execution. We need to offset this.
So if we summarize, there's still going to be a lot of geopolitical impact this year.
Not going away.
Not going away. There's still going to be inflationary pressure, at least in the US and maybe in other countries as well.
Yes and no, because I don't know how to answer that one. We know the president is mandated to bring inflation down. Now you can do it via lower rates. He wants lower rates. But he's also dictating what companies should do to help him bring inflation down faster. That could mean asking IT companies to participate in rebuilding the electricity grid. That's not good for profit margins. You could ask US banks to lower interest rates on credit cards. That's not good for profit margins. And you can ask home builders that there's no more stock buybacks. We want you to build homes. That could be bad for profit margins. So the uncertainty about the US is how the political world will go in terms of trying to lower inflation with these non-traditional measures. That's why I still like Canada over the US. But to your main question, the stock market seems to be the place where you want to be right now, but I can't promise you that's the place where you need to be for the rest of the year. So for now, okay, but don't forget what I showed you before. These profit expectations are
so
high.
Well, Stéfane, as usual, was an amazing presentation. Very happy that I have the chance to do this with you again this year. To all of you, I hope you enjoyed it. And thank you for being here, and we'll see you in February. Merci, Stéfane. Thank you.